I thought about it. I was like, look, an underwriter and a venture capitalist sort of doing the same thing. They're looking at businesses, doing similar kinds of analyses, looking at a lot of the same data and trying to determine the risk of the good, the bad, and the ugly playing out. So why is it if our skills and the analysis is the same, why do we have such different takes on maybe even the same company? A VC is capped downside, relatively uncapped upside. An underwriter has capped upside, relatively uncapped downside. That's very painful. Hey, everybody. This is a shorter and different episode. Just some free thoughts from me between interviews that we would normally bring you. Just wanted to share some thinking. This is something I've talked about in the past, but not on the show. And I thought it could be some value in it. I did something similar with thoughts on sales, selling tactics, outreach, relationship management, and all that in the insurance industry. And surprisingly, it resonated. So I thought, well, let me do another one of those, but on a different topic. So something that has always kind of caught me off guard or been a surprise to me is why we are so risk averse in the insurance industry. And if you think about it, we go around buying risk. Shouldn't we love risk and be comfortable with it? Shouldn't we want to take risks and get into new things and be willing to experiment? And the reality is, we're not like that. And I know that's not a surprise to anyone in the industry or lots of folks outside the industry who see us and think, oh, it's a very conservative, slow to change, risk averse kind of population. And it makes sense. Yes, we do go out buying risk from other people. We take on the risks of other individuals, businesses, entities, et cetera. But once we do that, we package it down as tight as we can. We put restrictions on it. We put caveats on it, limitations on it. So we take risk and we try to remove pieces of it and get it as finite and defined as possible. So it's not totally surprising that maybe we aren't lovers of risk and like freewheeling with it, if you will. Like we want it to be defined. But something else occurred to me as I was talking to some venture capitalists who were evaluating a solution in the underwriting space, so a tool for underwriters. And the way they were looking at the company, to me, was very similar from the way that an underwriter would look at a company, for a D&O risk or E&O risk or GL or BOP or what have you. Is they're evaluating that business, how it operates, the pros and cons, the risks, the opportunities, et cetera, to see, where could problems lie? A lot of times, especially in D&O, like there's a financial analysis, just like there would be for a VC. So it's kind of weird to me as I thought about it. I was like, look, an underwriter and a venture capitalist sort of doing the same thing. They're looking at businesses, doing similar kinds of analyses, looking at a lot of the same data and trying to determine the risk of the good, the bad, and the ugly playing out. So why is it if our skills and the analysis and the kind of perspective we're taking is the same, why do we have such different takes on maybe even the same company? And this is when it hit me is I don't think anyone's ever made this analogy before, but or caught the likeness. But insurance is and VC is kind of like Stranger Things, the Netflix show, not just weird things in general. And by that I mean the upside down and the real world. You've got two different worlds. They're sort of like you go through the ceiling and you come out the floor on the other. It's like one is the inverse of the other, or the upside down of the other. And look, one is a horrific, terrible place filled with monsters. The other is what we're all used to, which you could also argue maybe is a horrific, terrible place filled with monsters, but at least it's not always dark and not everything is trying to eat you. So there's like the good world and the bad world. One is the inverse of the other. I'm not going to say which one is the underwriter's world or the insurance world and which one's the VC world. I'm sure everyone has their views, but what do I mean by that? What the inverse or the kind of mirror image of each other? Well, here's the deal. We're both looking at companies in a lot of the same ways, but we're doing it from like opposing directions. And if you're just listening to this and not watching the video clips, move my hands apart from each other. They're going opposite directions. And what do I mean by that? Well, if you think about it, a venture capitalist has a fixed amount of money that they're going to put in. That's the downside. So we're going to invest $1 million. Worst case scenario, we lose $1 million in this. Yeah, plus our time and any expenses of like traveling out to meet the team or whatever. But effectively, $1 million in the line. The upside is not actually unlimited, but more or less it's unlimited. What if you put in $1 million as an early investor into Google and you held it all the way through to IPO and well beyond that. Well, it's not technically infinity, but your upside, your return, if you were to sell today, is somewhat close to infinity. It's massive, massive, massive scale of upside, effectively unlimited, or in the realm of reality, like your $1 million could turn into several billion dollars. And that feels pretty unlimited to me. I know technically it's not. Mathematicians out there, you wouldn't like this, but more or less, right? Massive upside, effectively uncapped beyond just reality, right? But their downside is capped. So worst case scenario, down $1 million. Best case scenario, up billions and billions of dollars. Early investor in Apple, same kind of thing. Early investor in lots of companies. Very little at risk, a lot of upside. And there's lots of things that happen along the way. It's not a straight line. There's moments where it looks like everything fell apart, et cetera, et cetera, et cetera. But by and large, the VC is looking at a capped downside and at least many multiples potential upside. An underwriter is looking at it exactly the opposite. The upside is capped. It's our premium less whatever commission or acquisition costs and expenses, et cetera. But for the sake of argument, let's just say it's premium minus commission. Say you get a $100,000 risk, you pay 20 points to a wholesaler who brought it to you, 80K. That's the most that insurer is going to make. Now, yes, they will invest some money and get some return on it, but for all intents and purposes, what's that going to be? $90,000, maybe $100,000, depending on the tail, maybe $200,000, but more or less, it's pretty capped, right? Just in the same way that like it's an uncapped upside for VCs, effectively speaking, we're talking about a capped upside for insurers. Call it premium minus commission, so 80K. All right, let's for the sake of argument. The downside is not so capped. Now, you could say, well, Bryan, there are limits. So it is capped. It's not a unlimited tail and an unlimited downside. Well, for some lines of business, some aspects of it will be unlimited, like if there's defense outside the limit, or if you're doing workers' comp, you could be paying for someone to be on pain meds and getting treatment for literally the rest of their life. That doesn't cap out. So effectively speaking, in a lot of lines of business, the downside is uncapped in the same way the upside for a VC is uncapped. Now, let's say you're looking at like a 5 mil limit for that $100,000 premium. So there's a cap to it. 100,000 upside, 80,000 net to 5 million downside. Well, if you do the math on negative 5 million versus 80,000 positive, that's not technically infinite, but it's a massive multiple. And that's a lot of pain to feel for a small fixed potential upside. And that's if you get 80,000. I've seen plenty of $10,000, $20,000 policies premium wise with a 5 mil limit. That's, 20,000, you're talking 16 grand if you wholesaled that. So 16 grand on the upside minus expenses and 5 million on the potential downside. That's a really bad ratio. And this is the framing of an underwriter versus a VC. A VC is capped downside, relatively uncapped upside. An underwriter has capped upside, relatively uncapped downside. That's very painful. And I think a lot of this stuff goes on subconsciously. So an underwriter's not saying like, oh, my world is very upside down and feels very negative. It's just how they do their work and the economics of what they get to play with. And a VC is doing similar work, but the economics are completely inverted from a risk and reward standpoint. Really interesting. And you can say the likelihood of the upside or the downside is different in the two. It is, it may be, but then you think about frequency. Not every policy has a claim. So actually, just like not every business that you invest in is going to become a unicorn or blow up and do really well, it's also not going to go out of business, all of them, right? So I think actually we're not that dissimilar in the sense that the upsides and downsides have some flexibility to how often they play out. One has a capped upside and an uncapped downside. One is a capped downside and an uncapped upside. Now you can start to understand why, even though the analysis may be the same, the sentiment around what you're looking at could be wildly different because your whole economic framing is reverse of each other. I don't know. Not earth-shattering stuff, but it struck me one day as I was talking to this VC and just sort of thinking about all of it is like, wow, it's the same skill set. why do we struggle with this? Why do we struggle with looking at it in a more positive light or seeing, the bright side of things? Well, the bright side is very fixed for insurers. It's the dark side that's not. And VC gets to live in the opposite direction. I'm not saying their life's easy. I'm not saying an underwriter's life is hard or vice versa. I'm just pointing out the framing is night and day, kind of polar opposites of each other. And I think that explains a bit of why we might look differently on it. Why does that matter? Well, it doesn't have to, but if you're at an insurance company and you're trying to make change, you want to push forward, you want to think about how we could move forward, what we could possibly do opportunity-wise, growth-wise, performance-wise, just understand from a subconscious standpoint, the wiring that you're working with is framed in a way that actually is not comfortable with that. It's framed in a way that sees a lot of downside relative to limited upside. And you could say, well, we're intelligent people. We get that. We'll be fine. But this is a subconscious wiring kind of thing. And I promise you, you're not even aware of it most of the time. And you can say, oh, I get it. But I've seen quite the opposite. So as an example, few examples. I've worked at carriers that are used to having more long tail business and they get into some short tail business. And for those who don't know, long tail means you sell the policy and it takes a while before the claims actually present themselves, play out, and you know what you're going to end up paying. Medical malpractice insurance is a great example of that. Workers' comp, GL, especially occurrence lines where it's tied to when the loss happened or the event happened that caused the loss, not necessarily the policy year. So you could see a 12-year tail on a medical malpractice insurance, for example. That's a really long time. Conversely, short tail is like, think about auto accident, right? Like we wrote the policy in 2025, there was an accident in 2025 and we repaired the car, or there wasn't. You kind of know within 12, maybe 18 months. But generally, short period of time relative to when the policy was active year of account that you know the total value of the claim. Now, obviously, like litigated matters, bodily injury, that stuff takes longer, but like the auto physical damage, generally speaking, pretty short tail. Same thing with property. The actual like repair to the property, the damage to the property, generally speaking, short tail. It's the liability stuff, the more complicated matters that are, negotiated, litigated, et cetera. Like that's the stuff that takes longer. If you are used to writing short tail and you get into long tail or vice versa, and I've been at carriers that have been on both sides of this equation, you will be incredibly uncomfortable with what happens with the development. So I was at a carrier that did more long tail. They started writing shorter tail business. They got into property. And, within the first year, there was a lot of claim activity relative to what they were used to on the professional liability and D&O and those sorts of lines that they were used to writing, where you sell the policy and it's going to be quiet for probably a couple of years, maybe 18 to 36 months before you start to see the claims really develop. And on this property book, it was like just a few months from inception, they're already starting to see payouts happen and they're starting to see reserves go up. And the leadership team, who is brilliant, deep insurance expertise, was really uncomfortable. And we're like, we made a mistake. We should never have done this. This book is terrible. It's performing poorly. But lo and behold, after 18 to 24 months, things quieted down. That book was pretty much at its ultimates and they knew how it performed. They just weren't used to that. And I saw the opposite, where I had a short tail carrier who got into longer tail business and they thought everything was good. A year passes, there's very little loss activity, there's very little development, very little reserves. They sort of put it out of their mind that that piece of business could ever be an issue. 2 years on, things were developing. There were starting to be reserves, and they were thinking this was money in the bank. We could release all the reserves we were holding and be done. But now you've got case-specific reserves on some claims that developed. And meanwhile, they thought that they were in the clear, and suddenly they're not. So they got very uncomfortable. Maybe this is the wrong line of business. We shouldn't have been doing this. Actually, it was performing really well and to expectations, just not how they were wired from decades of living with the opposite tail from what they got into. Smart people, they understood all that. We could have this conversation about the tail. We could have this very conversation about your comfort with the tail. And it still didn't feel right to them because it's not how they were wired. So breaking from what you're used to, what you're wired to think, your subconscious framing around it, it's really, really tough. So I share all this just as a point of awareness, it's worth having the conversations about what are we actually used to? How are we wired? And if we're going to be doing things that require us to stretch from what's comfortable, maybe we need to spend some time on getting ready for that and thinking through that and putting the right markers in place to help us through actually judging it versus going back to our sort of subconscious wiring and thinking about how that might lead us to a suboptimal decision because we got antsy. This is why people pull money out of the stock market at the wrong time or put money into it at the wrong time. So many different things happen like this. And I'll leave you with one last example. And it's something I use in these situations when I talk to people about like, oh yeah, we've got this. We understand. We're smart. We don't need to, do any work on it. We get it. The tail's different or, the upside, downside's different, et cetera. I always ask, are there any parents in the room or are you a parent? And anyone who says yes, I said, remind me when you were about to have your first kid, were people telling you about the sleep deprivation? Oh yeah, and everyone was talking about it. And so they like start to share stories about it. I said, and how did you think about it? Were you like, oh my gosh, we're not ready for this? Or you're like, oh yeah, I've stayed up late before. I'm a smart person. I understand the idea of being tired. I've pulled all-nighters. Whatever the justification you did in your mind for why you would be all set because you understood what being tired was. And then you actually had the kid and you didn't sleep for weeks. And then they're like, oh yeah, I learned pretty quickly. I didn't understand at all. This is the same thing, right? It's not that you're not intelligent. It's not that you can't think outside the box or understand like, this is a different situation from what I'm used to. I understand it'll play out differently. I get that. Once you're in the throes of it, your wiring will lead to your first reaction. And that's not always going to be helpful. So I share all this as a point of awareness. It's worth having these conversations, especially if you're trying to make change or push an organization through to something new and different, hopefully better. Just be aware. People are people. There's nothing wrong with this. This is just how we're wired. And we reinforce that through the years of, great experience and performance we have doing what we've always done. Now we're trying to do something different. It may not feel so good, even if it is. So be prepared for that. Have the conversations. I hope that was helpful. And of course, check in next time for another great episode of The Future of Insurance. See you, everyone.